What's going on, everyone? My name is Nicholas Merton here at DataDash, and today is December 19th of 2022. Well, folks, I hope you are having a fantastic day wherever you are, because in today's video, I want to spend a little bit of time to talk about what I feel is a genuine and honest outlook on where Bitcoin's price is going to head into the month of January. As we've gotten many price signals from both Bitcoin, Ethereum, and the broader asset markets, as well as our data science models, it is becoming evidently clear that there's weakness in the market and that the bears are in full swing, leading us down to what could very well likely be one of the major last flushes for Bitcoin's price to the downside. We're going to be talking about all this and more as we go throughout the video. If you consider dropping a like, it's one of the greatest ways you can support the channel. But let's go ahead and kick off the conversation. So I want to go ahead and signal one important thing here, and that is the momentum and moving averages for Bitcoin. Now, as you can see here, as we usually do on the channel, we like to analyze the long-term time frames. And if you take a look at the weekly time frame, it is evidently clear for anyone who's traded for a long period of time that there's weakness in price, severe weakness, something that we have not seen to this degree in Bitcoin's price throughout its entire history. Uncharted territory. As we've seen throughout this bear market, each and every relief rally has not only gotten weaker, especially considering the fact with the positive CPI report that we recently got, all we did was move from around $15,000 to $18,000. And yes, we're on the logarithmic chart, folks. This means that it's acting to scale here. And we can see that the price recovery that we had back here from 17,000 up towards 25K back during the summer was much stronger. Not to mention the recovery here in September from 18,000 to nearly 22,000 was stronger as well. So we can see that the price action alone is getting weaker and weaker. We are not seeing people buy the dip as much as they were back in the past. Already a concerning sign. But outside of that, we are far away from not only retesting the 200-day, which we couldn't even do after a major positive upset supposedly in the CPI report for inflation, but on top of that, we are incredibly far away and growingly distant from those 200-week moving averages. Now, again, I'm just going to zoom out on the chart here. And I want to ask you guys again, as we see from time and time again throughout history, where the 200-week used to be the ultimate buy the dip opportunity. We used to use it as well, buying the dip during previous bear markets. Take a look at where we're at now and how buyers are not coming in below that 200-week moving average. We not only weren't able to hold support here, but we are well below that 200-week and continuing to set in new lower highs and lower lows. The trend is deviating from that historic norm, and that is a major concerning sign. We've been talking about this as far back as August on this channel when we took our positions out of the market into cash. It's why we got to follow those signals that the market is giving us. Now, on top of that, it's not only Bitcoin that's down at the moment. If you take a look at the last 7 days, if you've been in cash, you've avoided a lot of potential downside in plays. The vast majority of the crypto market, either in upper single-digit territory to the downside or in negative territory with double-digit losses week over week. But I really want to draw your attention here to one of the big plays that I think a lot of people have been hoping is going to somehow break away from the trend. One that is going to lead forward as it has been throughout 2020 and 2021. And that, my friends, is Ethereum. Now, I have to say that I think a lot of investors have been living in la la land when it comes to Ethereum. Trust me, I'm a big Ethereum head. I've had a crypto wallet in the Ethereum space that's focused on DeFi, and I'm very big on Ethereum as a network in many ways. I think Ethereum, throughout the crypto space, has been a huge asset towards bringing forward ideas of smart contracts and NFTs and all types of different things that could really bring a lot of value to the crypto space that Bitcoin never really had. But I gotta be honest with you all, not only is Ethereum at these levels, just on a pure price perspective, way overvalued comparative to where it should be in a bear market. So this is problem number one, in my opinion, considering the fact that it hasn't drawn down against Bitcoin being more of a risk-on play and a higher growth play during the bull markets. But on top of that as well, the momentum and all the things that make Ethereum very valuable, DeFi, NFTs have completely been shot. They're completely dead at the moment. There is no new exciting DeFi protocols being built at the moment, at least any major ones that I think are going to completely shake up the industry. There are those we are watching and are really building exciting things here during this bear market, but I gotta be honest with you guys, not enough to suspend Ethereum's valuation at these heights. And what makes matters worse is that as we're going through this big restructuring period in the crypto space, as we've talked about with plays like Kava or Radix, that could potentially radically transform the way that the developer process works in crypto, I think that there's a good chance a layer one that is serious about restructuring the way developers and users interact within the crypto space could start to take down Ethereum at a minimum, spook the markets and lead valuations down towards a more healthy range, a corrective range where people would soundly be able to buy the dip. Essentially speaking, I'm looking for history to repeat here. I'm looking for us to come down to this line of historic support, which we've highlighted for a long period of time. It's what helped us in many ways to be able to pick Ethereum at $80 to $100 during the last bull market, buying the absolute bottom, which was again one of our most legendary plays in the cryptocurrency space. I'm going to wait around this time because I've seen how history can repeat. And when I take a look at the previous bear market for Ethereum versus now, I think what we had in the summer was our April to May 2018 rally for Ethereum, which is going to slowly but steadily roll over with lower highs and lower lows down towards a lower level sometime in Q1 to Q2. And that's when we're going to be buying. That's when we're going to be deploying and dollar cost averaging our capital into Ethereum. But even if you put aside the agreement or not, or disagree with my price projections of Ethereum coming here to $300 to $500, I want you guys to again just take a look at the price here. Lower highs, lower lows. Price is not signaling any optimism. And with this week's Fed reaction down 6.3%, it looks like we are born to roll over here, roll down to lower levels. And once you apply those moving averages, we can see that the 200-week moving average is now acting as resistance, a very big weakness sign. If we can learn anything from Bitcoin, it should give us some information about what it's going to do to Ethereum. Now, let's go ahead and run through some of our data science models here. Now, as you guys know, we have a partner here on the channel called CryptoQuant. They are our data science partner here on the channel. And what's really cool, as I always try to emphasize, we've got a lot of you in the community who are following the board because it is a free tool you guys can access. I definitely recommend you guys check it out on CryptoQuant. I'll have it linked down below in the description, and you guys can heart and star. In this case, helps to bring more awareness to some of the models we watch. And as you all know, if you've watched the channel for a long period of time, data science is one of our expertise here on the channel. Now, there are 4 major models that we watch here on CryptoQuant. Let's go ahead and take a look at some of them. The first one here, the NUPL, net unrealized profit or loss, tracking how much of the market is an unrealized profit or loss territory. And we are definitely on the latter half here of this bear market when it comes to declines and valuations. But as you all have seen here, we are going through what I believe is the real first bear market for Bitcoin. Rather than the kind of typical 80% drawdowns, I think we've got a chance for a 90% flush due to the fact that we are going through a real proper recession, something Bitcoin has never really witnessed. And if we take a look back through history, even some of the previous bear markets within crypto, or those corrections, have basically taken us down to much lower levels than where we are now. The fact that we've spent lots of price time within this range signals a lot of fear for where price is likely going. I want to take a look as well at that Korean Premium Index. You guys know that we've talked a lot about this indicator, and as again, with time throughout history, we can see that each and every time we got these bump ups here during the bear market, it was the buy the dip speculators that eventually aren't enough to support price going higher for the next bull market. We need to see this level fade into negative territory to start getting really excited about capitulation in the market. Once more, we have to take a look as well at the SMA, or supply and profit, the SMA 30 for the supply and profit percentage. Now, this is one of our custom data science models that you guys will only find on our CryptoQuant data science board. And again, this is focused on trying to figure out if we can find any consistent trends within bear markets where the supply and profit is at a certain range before price bottoms. And what we found is the historic level that gets very interesting is around 44 to 48 points, We've seen this with practically every single bear market throughout the past. So I would assume at a minimum, even if you don't believe that we're going to correct more than a typical Bitcoin or Ethereum bear market, that we should at a minimum come to a similar level here, considering the pressures of inflation and the broader downturn in asset markets. And right now, the lowest level we had, which was back in early December, was around 49. We are still a decent distance away, especially now that we've elevated back up to 51 points on the model. And last but not least, this is something that, again, I really want to beat like a dead horse here. I don't want to be harming any dead horses, but you catch my drift. This is a key point that I really want to take home for a lot of you guys, and that is the Puell multiple. Puell multiple here is a clear sign that we have not seen what needs to happen, and that is capitulation in the mining industry. This is still yet to happen. And I don't know if it's going to happen through the operations that, for example, Celsius is trying to get rid of on its books, or if it's going to happen through a variety of the commercial, publicly traded companies that are exposed in the mining sector. If we just simply take a look at some of those equity plays, you take a look at Riot Blockchain, if you take a look at Hut 8 Mining Corp, all these companies are screaming red flags. Week by week, the vast majority of the time, we are seeing downward moves, sometimes in double digits, and according to their valuation. And it's because the insiders, the investors, they know something is up. Someone is going to fall. Who is going to be able to survive this? Because if we take a look at the mining hash rate for mining, not just the Puell multiple, it is a dire warning sign that there are too many people overexposed in the mining industry, especially with how low prices are. The question is, how long can they survive? The vast majority of them, they're not going to be able to survive for very long. Now, to seal the deal here, take a look at equities, right? And again, keep it into the weekly time frame. No need to conflict yourself with what's going on in the hourly time frames or the 5-minute chart, guys. That's the big mistake people make, trying to trade too frequently during these bear markets, which will chew up investors and tug on your emotions. Take a look here at the NASDAQ. As we talked about, a lot of people were getting excited. We were pressing up towards that 200 week. And this is the kind of rationale that people get caught up in during these bear markets. The people who are still in that mentality from the last decade of buy the dip, buy the dip. Now, instead of pressing back up towards the 200 day and thinking we're going to break out above there, now we're pressing up towards the 200 week. Isn't that a sign that we're breaking out and starting the new bull market? Which, bear in mind, is a lower and a bigger sign of weakness here. I mean, we should, at a minimum, if we're considering getting into the next bull market, be able to make the 200-week support. But we weren't able to do that. Down another 2.72% after an already 4% downward move in the first week of December. Not even coming close to that 200-day. Can you all start to see, again, for those of you who might have been on the bullish side, I'm not trying to be bragging by any means. We've definitely made wrong calls. We're not absolutely perfect here on the channel. But do you see why we've emphasized the importance of these 200-day moving averages and the failure to hold the 200-week? Because now it is no longer support like it's been for the last decade. It's now resistance. And that tells you all you need to know about the trend. And it's not just the NASDAQ here, which is struggling with the 200-week. We can take a look here at the S&P 500 and the Dow Jones, which are struggling with their respective 200-day moving averages. Yet again, getting shot down right in that pocket between the 200-day and the 200-day moving average and the 200-day exponential moving average. A nice 17% relief rally, deviation above that 200-day, and boom, 2 weeks of red price action. And to make matters worse here, the safe stocks, the Dow Jones. While a lot of people are hoping that this is going to hold on that 200 week, we have seen that when we deviate and we close below that daily moving average, we are setting in lower price levels than the previous significant lows. That means the Dow Jones at a minimum is likely coming down to 27,000 points. And that is going to weigh down. If the defensive stocks are getting weighed down like that, it's going to weigh down the FANG stocks. It's going to weigh down the high growth stocks. It's going to weigh down the S&P 500. And this is nearly exactly what played out during the 2000s. if we zoom out through history, there were plenty of times where we deviated on the Dow Jones, those safe defensive plays above the 200-day. And each and every time we rolled back down, new low, new low, new low, new low, new low, until we finally set at a bottom. Multiple times we had to go through this repetitive process. And it happens within a lot of bear markets. It happened in 2008 to a large degree, right? We have to have these multiple waves where people have hopium that the Fed is going to save them, only to continue to fall lower and absorb that excess liquidity that's causing inflation in the economy. Not everyone, as I've said before, not everyone is going to easily be a millionaire just buying stocks and crypto, folks. 2021 made us believe in that crazy hypothesis that the Fed, all the liquidity it's printed, everyone is just going to be rich. Everyone is going to have Lamborghinis and all these frivolous, unnecessary things in the world. And it's why I don't feel too much sympathy. You want to know the people I feel sympathy for? People who are struggling with inflation. I don't feel much sympathy for people who have taken too much risk and don't know when to take it off the table. It's likely a sign that you haven't earned that money. And trust me, I've had to learn that the hard way myself. Being too overexposed in crypto at some points, being too much all in on one bet. And I realize after making those losses in the market over the last 11, 12 years of been trading in equities and crypto, you realize it's a lesson to be learned from, to not repeat it again. And you got to protect and preserve your capital at all costs. It's not about thinking about what money you can make. It's about thinking how much you can lose on an investment or trade. That's the key lesson that so many people never take the time to really ask. And it's the difference between a successful investor trader or an unsuccessful investor trader that can potentially lose everything. Anyways, guys, I've rambled on long enough. If you like this video, consider dropping a like, especially if you've listened to me this long in my rambling session. I hope my rambling has provided some value for you all. I really appreciate the continued support you guys always show. Stay tuned for more content later on this week, and I'll see you all in the next video. Take care, everyone.